Hello, everybody. My name is Connor Cheney, and today I will be discussing a current event dealing with the leading up to a possible housing bubble 2.0. The movie The Big Short does a great job of explaining the housing bubble catastrophe in 2008, and I highly recommend watching it if you haven't before. Personally, I've watched it about 10 times. Moving on to the context of the current event. As of recently, the current housing market patterns are becoming significantly similar to the pre-recession patterns in 2005. Since the crisis has ended, the housing market has regained the value lost and has grown even more. The crash made the average home value decrease by 37% since the pre-recession, and the home value has now risen to 70% above the post-recession low. The article from USA Today did some research on a list of 15 popular cities to see how far the housing value growth has gone. Seattle, Washington, the city with the least amount of growth, was 23.1% above their pre-recession peak prices. And Greeley, Colorado, the city with the most significant growth, was 79.2% above their pre-recession peak prices. As you can assume, this growth is extremely fast. Too much growth too quickly, like the results shown, can lead to market instability and put the market or the housing market and economy at risk. Now I'm going to explain what all this context actually means. According to the wealth effect, when the average house value starts to increase, it also leads to an increase in consumer spending. The chart on this slide breaks it down pretty well, but I'll explain it a little more in depth. When consumer spending is high, householders will generally be more confident with spending money and lending from credit cards. They figure that if there's an emergency, they could always sell their house. But that's definitely not always the case, especially with an economic crash. Increased consumer spending also causes banks to be willing to reduce their reserve ratio and increase their lending to the consumers, allowing them to get larger mortgages. But when there is a crash and consumer spending goes down, the opposite happens and problems occur, which I will explain later in the presentation. As you can see from the previous housing crash, the consumer spending had a drastic change. When housing prices were on the rise in 2006, consumer spending went up an extra $14 billion. But when prices fell in 2008, equity withdrawal was at a negative $7 billion. Currently, the housing market is starting to become unaffordable, which is another hallmark of a housing bubble. The median home value is now 3.61 times the median household income. Even though there are a lot of healthy job markets and high incomes, rapid rising real estate costs can be difficult to afford. Now let's talk about the career fields that are affected by the housing market and could struggle if a crash were to happen again. First off, the most obvious career field affected is real estate. When there's nobody on the market looking to buy houses, it is very difficult to succeed as a real estate agent. Next, we have financial services. From the chart, you can see roughly 1.5 million financial service jobs were lost during the recession. When a housing market crash occurs, banks and investors are put in a difficult situation. This means banks are forced to decrease their lending and most times end up losing money with a decline in their asset value. Real estate investors and advisors also become uncomfortable with their practices and typically have to wait until the market is fixed to start back up. Moving on, the graph also shows the negative effect of the recession on construction jobs. Construction was affected the most according to this chart and lost almost 2 million jobs. The construction field is volatile, and when house prices are falling, people typically stop investing in and building new homes. Without the ability to continue making new homes, a large percentage of the construction field gets hurt. Lastly, we have manufacturing. Manufacturing isn't directly on the chart, but it fits in with the durable goods and retail sections. Without new houses and renovations, there is very little reason to be buying manufactured goods such as furniture and household appliances. To wrap it all up, the housing bubble isn't definitely coming, but the risk is possible and needs to be taken seriously. A crash would negatively affect the economy as a whole, so let's be smart and not let it happen again. Thanks for listening.